Welcome to today's video, where we'll dive deep into the GCC's growing economic presence in Latin America following the Rio G20 summit. From critical minerals to food security and infrastructure, we'll explore how the Gulf is reshaping its global influence through strategic investments in the region. Let's get started. Let's start with critical minerals, which are essential for clean energy and technological advancements. Latin America holds significant reserves of lithium, copper, and nickel, critical for electric vehicles and renewable energy technologies. Latin America is responsible for 55% of global lithium production, with Chile and Argentina at the forefront. By investing in these resources, the GCC, particularly Saudi Arabia and the UAE, is securing future access to minerals that are key to their economic diversification plans beyond oil. For example, Saudi Arabia's Public Investment Fund has been increasing its stake in companies operating in the mineral-rich regions of Chile and Bolivia, ensuring the Gulf has a key role in clean energy industries. This is a crucial move as global demand for these minerals is expected to increase by 400 to 600% by 2040, driven by the green energy transition. Food security is another major area of interest for the Gulf. The GCC heavily relies on imports to feed its population, with food imports accounting for about 80 to 90% of its total consumption. Brazil is a top supplier, especially of halal meat, making up nearly 40% of Gulf food imports. The joint venture between Brazil's BRF-SA and Saudi Arabia's Public Investment Fund is an example of how these nations are solidifying agricultural ties. Meanwhile, the UAE signed a comprehensive economic partnership agreement with Colombia, focusing on agricultural products like fertilizers and meat exports. Latin America's agricultural production, valued at over $400 billion annually, is a vital lifeline for the Gulf's food security. Infrastructure is where the GCC's investments can make a significant impact. Latin America faces a $1.5 trillion infrastructure gap by 2030, and the Gulf states are stepping in to address this. For instance, UAE's DP World has already invested over $2 billion in port infrastructure across Brazil, Ecuador, and Peru, helping boost regional trade capacity. With trade volumes from Latin America to the Gulf forecasted to grow by 5 to 7% annually, improving transport logistics is key. This infrastructure investment ensures smoother export routes for Latin American minerals and food products heading to the Gulf. Gulf Sovereign Wealth Funds, or SWFs, are driving much of this investment. The combined assets of GCC SWFs are estimated at $3.5 trillion, with a significant portion now allocated toward Latin America. In Brazil alone, Gulf states have invested over $10 billion in the last 5 years. The Rio G20 summit encouraged new financial frameworks to attract even more private capital into emerging markets like Latin America, further accelerating Gulf investment into areas like renewable energy and tech startups. While the opportunities for collaboration are enormous, there are challenges ahead. Latin America's economic volatility is a concern, as the region faces inflation rates averaging 6.5%. Alongside political instability in key countries like Argentina and Peru. However, long-term projections remain positive, with the region's GDP expected to grow by 2 to 3% annually. The real potential lies in the future, where joint ventures in sectors like renewable energy could play a transformative role. With Latin America leading the way in solar and wind energy capacity, growing at 12% annually, the GCC is strategically positioning itself to be a long-term partner. In conclusion, the GCC's growing presence in Latin America is reshaping global economic dynamics. From critical minerals and food security to infrastructure and renewable energy, the Gulf states are establishing themselves as key partners in the region's future. With long-term investment strategies in place, the Gulf is set to play a pivotal role in Latin America's development, while securing vital resources for its own economic diversification.